The Lever. Subscriber-supported journalism that holds power accountable. As a Lever Premium subscriber, you'll get to hear exclusive bonus content from this episode and others in your feed. To become a subscriber, go to levernews.com.
From the Lever's reader-supported newsroom, this is Lever Time. I'm David Sirota. Capital One's slogan is, "What's in your wallet?" But what they don't tell you is that their ideal answer is nothing. Like other credit card companies, Capital One has been found to engage in manipulative tactics, like targeting people with low credit scores and tricking people into buying financial products that they don't need. But it's not just them. Credit card companies routinely charge people excessive fees for things like late payments, and the industry's lobbyists have pushed to make it much harder for Americans to reduce their debts when they file for bankruptcy. For almost 40 years in the U.S. Senate, Joe Biden was a reliable ally to the credit card industry. He spearheaded a landmark bill backed by the credit card industry to make it harder for debtors to get bankruptcy protections. At times, Biden was referred to as the senator from MBNA, a reference to the credit card giant that was based in his home state of Delaware. But this isn't the senator from MBNA anymore. As president, Biden has overseen an administration now taking a big whack at the credit card industry. His officials recently moved to cap late fees from the largest banks at no more than $8. That, of course, prompted a fierce response from the credit card industry, which quickly moved to sue the Biden administration. But Biden's initiative still represents one of the more direct challenges to the credit card industry that we've seen in a very long time. Today on Lever Time, senior podcast producer Arjun Singh is going to pull back the curtain on some of the credit card industry's most questionable practices. And he sits down with a former Capital One employee to hear firsthand the ways that the firm lured people into debt.
There's nothing like the gentle hum of a conference in Washington, D.C. The fact that I'm saying that probably means I've been reporting in the city for a little too long. But there was an electricity at this place that I was at on Tuesday. That's because I was at something called the Anti-Monopoly Summit, an event hosted by the American Economic Liberties Project.
I hear from a lot of people that there's this idea if you're rich and you're powerful, you're above reproach. And I think the FTC calling attention to that just shows that we can have government leaders, just like Chair Khan said, who are willing to fight back.
Lever subscribers and those who've been listening to this podcast may be familiar with the AELP. A couple weeks ago, their research director, Matt Stoller, joined me to discuss price fixing in the oil sector. The AELP is this think tank that focuses on the influence of corporate power. And as such, the theme of this summit was how to break up monopolies. But I was really interested to hear from a specific guest.
Formerly, he was an FTC commissioner, and he's, of course, currently leading the CFPB. The Bureau is protecting everyday...
Rohit Chopra, the director of the Consumer Financial Protection Bureau. Most recently, Chopra's agency survived efforts to defund it when the Supreme Court protected how the agency's funded. Something he was pretty happy to tout on Tuesday.
After years and years and years of litigation, the Supreme Court, believe it or not, ruled in favor of the CFPB in an effort to stop really a way to defund the agency and really kind of shut it down. And I think
the news was interesting to me because in the last few years, the CFPB has actually made some pretty big moves, particularly when it comes to regulating excessive fees levied on people by credit card companies and banks.
We put out a rule a few months ago regarding credit card junk fees. And so what we found was that there was a loophole that the credit card companies had been abusing for years and years and years to extract an extra $27 million a day, $10 billion a year. We finalized that rule, and the junk fee lobby sued us. And so that too is in court.
Right now, a lot of their rule changes are caught up in the courts, but Chopra's activist stance is still notable. Apparently, he even has plans to reform how credit card points are used.
Right now. And don't worry, I'm going to ask about the points on the credit cards because people want to know if you're coming for the points, Mr. Director.
Well,
are you trying to take away my points?
Well, we're actually pretty worried about these credit card companies engaging in massive devaluation of points. They want to say you're going to be able to use this for free round trips, and then you try and use it, and it's almost worthless. That is not right. So we are actually trying to make sure that the promises are being kept.
Considering everything that's happening in the world, credit card travel points are probably not a top-of-mind issue. Nor should they necessarily be. But what Chopra's hinting at is the massive power the credit card industry and its lobby has over people. Credit cards play a huge role in people's lives. Credit scores, for example, are the key to determining how much your car insurance costs, or if you're eligible to even rent a home. For some people, credit cards are what helps them stay afloat, but it can also be what ends up sinking someone come time to pay the bills. And as an industry, it's huge. Last year, the Government Accountability Office estimated Americans had more than $1 trillion in credit card balances. That's almost half of Canada's GDP in 2023. And you might be familiar with that old MasterCard commercial.
There are some things money can't buy. For everything else, there's MasterCard.
That's been especially true here in DC, where MasterCard has spent more than $1 million in political donations. And that doesn't include the millions more the industry as a whole has showered politicians with. If you want a prime example of how the credit card industry works, here's one example from 2005.
My question is, if they cannot pay those bills because of an extended tour, which many are going through, and they have to declare bankruptcy, should the creditors who have lent money to them based upon their initial income, should they be the ones that are pay the cost in effect?
Yep, that's Joe Biden, back in the day when he was a senator. Throughout his career, Biden had always been boosted by the credit card industry. And the reason Biden's asking about bankruptcy is because he was backing a bill that would make it harder for people to discharge debt via bankruptcy. A bill the credit card industry had been supporting for years. For people who only know the Biden of the last 16 years, it's worth knowing that for a long time, Biden represented Delaware, the home of Chase, Discover, and a little-known credit card company called MBNA. MBNA was eventually bought by Bank of America, but they used to be Biden's largest contributor. In fact, when Biden's son Hunter needed a job, guess who happened to have a six-figure salary waiting for him? Yup, MBNA.
In retrospect, wasn't it inappropriate for someone like you in the middle of all this to have your son collecting money from this big credit card company while you were on the floor protecting its interest?
Absolutely not. My son graduated from Yale Law School. The starting salary in Wall Street was $140,000 a year if you went to lawyer. Options he had. He came home to work for a bank. Surprise, surprise.
Over the course of his time in the Senate, Biden would vote to deregulate banks, and he repealed part of the Glass-Steagall Act, something that helped commercial banks trade in financial securities. That's why it was surprising when that senator turned out to become this president.
Right now, credit card companies charge an average of $31 whenever you can't pay your bill on time. Today's rule proposes to cut those fees from $31 on average to $8.
It's rare to see a win of this scale for the American public. I mean, this was an extraordinary rule on late fees that's going to save billions of dollars in the aggregate, and on average over $200 per year for many families. You know, the late fees rule really cuts to the heart of why it's important to have generationally good regulators, because unless our regulatory bodies get involved, these companies are going to do everything possible to use every tool at their disposal to squeeze and extract more more out of American consumers.
Bilal Beydoun is the Director of Policy and Research for the Groundwork Collaborative.
The root of why these companies are able to do this really is concentration. There's been enormous concentration in credit cards, and these credit card issuers have paid comparison websites, to boost their products. These are websites that families rely upon to make major financial decisions, like, taking out a mortgage or an auto loan.
I wanted to talk to Bilal because he's been looking at this issue from a larger perspective than just personal finance.
I really think about affordability, cost of living. What does it mean to live a dignified middle-class lifestyle? In order to do that in this country, you have to borrow. You got to borrow for a house. You most likely have to borrow for a higher education, for a vehicle to go to work, to drop your kids off to school, and credit cards, to feed your family and do all the things that you need to do. And so you just have this sort of wide web of predatory pricing that's emerging, algorithmic driven pricing, what they call dynamic pricing. And so against that backdrop, these credit card companies are really winning, because what happens is, if you're a struggling family and you're paycheck to paycheck, you want to go buy diapers for your child. The diaper company, as we've focused on, has already jacked up their costs because they were able to do that during the pandemic. And so when you swipe your credit card and you have to carry a balance on those diapers, guess what? When Capital One is charging 35% APR on that purchase, suddenly that diaper purchase, which is already inflated because of corporate greed and corporate profiteering, is going to follow you for the rest of that year and cost you more and more every month.
And remember when Rohit Chopra was talking about why those rewards points aren't all that they seem? Turns out that that's part of a web of predatory tactics credit card companies use to prey on people.
Some of these companies have been fined in the past for, they've opened up unauthorized accounts at times. They've made serious billing errors that they've failed to correct until people reach out. Citibank was actually fined for basically analyzing applicants' last names to see if they sounded Armenian, under the absurd and deeply wrong and discriminatory notion that Armenian applicants would be somehow worse applicants than others, and actually were slapped with a fine for that. So you simply cannot leave these credit card companies to their own devices, because that almost certainly will lead to some of these practices that we just went through.
The other thing is these fees can contribute to more problems downstream in the economy. Think of it this way. The more money that people have to pay credit card companies is less money that can be spread around the rest of the economy.
Anytime you see corporations exploiting an economic emergency or a perceived economic emergency, everybody pays the price. When they jack up their costs, it contributes to inflation. When we have inflation, the credit card companies are rewarded handsomely because they get a greater share of, those inflated prices, both in terms of swipe fees, but also in terms of APRs when people carry balances with more expensive products. These junk fees are not small things.
The rapid consolidation of our banking system isn't the result of some natural phenomenon like gravity, that it just had to happen. It is the consequence of deliberate decisions by financial regulators that have made it easier for big banks to grow bigger by gobbling up their competitors.
That's Senator Elizabeth Warren from about a year ago. And she's talking about Capital One's ongoing attempt to purchase Discover.
It would create the sixth largest bank. And also, Discover is the fourth largest credit card payment network. So you have Visa, MasterCard, American Express, and Discover. Discover would be absorbed by Capital One. So that level of concentration, just knowing what we know about Capital One in particular, and especially predatory bank and credit card issuer, is really dangerous.
Even though more than 4,000 companies in the U.S. issue credit cards, most people only use cards issued by 10 companies. Together, those 10 companies control more than 80% of the market share.
No large bank, I think, is trustworthy. No large bank should be too big to fail. This would make Capital One too big to fail in some ways, which is bad for consumers, for the American economy. Capital One was penalized heavily for basically targeting people with low credit scores and tricking them into buying all of these add-on services like credit monitoring, like payment monitoring that they didn't actually need. And they actually misled people into thinking that those things would improve their credit. When you look at things like late payments, for example, there are already so many ways to, frankly, punish people for not making a payment on time. I think they are rewarded handsomely when people are late on their payments. And so you just end up with this architecture of cruelty where people are just being extracted for being in ever more precarious positions. I think economic precarity is good business for a lot of these companies.
And that's true. at least in the case of Capital One.
I think it's really important for people to recognize you can have exploitation without there being quote unquote bad people involved, right? Especially when people are outsourcing these really important consequential decisions to machines, right? And so all of the real consequential decisions then aren't being made by humans, they're being made by statistical models. And it's an environment where you get really isolated from the consequences of decisions, and like truly people just, they're looking at equations with no real concept of what the equation represents, which is people's lives and financial hardship.
After the break, we'll go into the belly of the beast and hear from a former Capital One employee about what she saw when she worked there.
I didn't have a credit card when I went to work at Capital One. I grew up in a family that had credit cards but paid them off in full. And like a lot of people working in finance, really just was not particularly exposed to what the most common experiences are like in America, right? The most common experience in America is to struggle financially. And like a lot of other people in banking, like maybe I knew that in a textbook way, but I didn't really understand what it meant.
Elena Botea is a former Capital One employee who worked in the credit card industry up until 2018. She's also the author of the book Delinquent: Inside America's Debt Machine.
Capital One strategy, often called low and grow, they're starting people on credit lines that are $300, $500, $1,000, and then raising them pretty quickly to $1,000, $3,000, $5,000. And part of the reason for that is that once somebody actually starts using your card, you know a lot more about them. That's when you can start saying what type of merchants was a person shopping at, right? And you're getting a lot more information that you can use to, make better predictions about how to get a person into more debt.
As Elena moved from position to position within the company, she learned something very critical. Nothing at Capital One was an accident.
I was a math major. I thought all the big data stuff was like so cool. And at Capital One, as is true in more and more places in the economy, people weren't exactly deciding like, I like strategy A or I like strategy B. They were deciding, do I like the methods that were used to build a certain statistical model?
At one point, Elena found herself in a new role where she was tasked with conducting experiments to see how much money Capital One could extract from people.
You have literally a test and a control group. So you can see what happens to people if you do not raise their credit line, because you're making random decisions some of the time to measure it. And so the bank is doing those experiments to measure like how much debt can I get somebody in up until the point that they're going to be in so much debt that they default because of that extra debt burden. People are getting into all this extra debt when they're in the test group, and the people in the control group aren't going out and applying for new cards. If they wanted or needed more credit, it would stand to reason they would be applying for loans, and they weren't. And when you realize almost all of that debt is new debt, like it really helps you understand that the amount of debt in America is really not driven by how much people want or need to borrow. It's really driven by how much the bank has decided that they want to lend out.
Eventually, Elena was moved to a team that sold what Capital One calls a secured card. These are cards that are marketed to people who would likely have trouble getting a regular credit card due to their credit score. And unlike most cards, these cards require you to put down a deposit.
People were paying kind of a lot of interest to borrow what is effectively their own money, like not really the bank's money, right? It's really their own security deposit. And then not getting a higher credit score. I was like, man, like that's grim.
Elena would eventually reach her breaking point when she was sitting in a meeting with management where they were discussing the company's goals.
The goals, like, they're delusional, right? Like, radically improve customers' lives, right? Like, woo, very, like, pie in the sky. And as we're doing this, somebody in the room asks, well, should we just have a goal that's, like, make more money, like, more revenue? And this guy who's my new boss is like, well, I don't really think we need to put that down because, like, if we do everything else right, like, the money's gonna follow.
Then Elena did something very taboo. She told the truth about what they were doing.
I was like, well, what is this raise interest rates project doing up there if we're not trying to make more money? Because it clearly does not fall into any of the other buckets. Like, certainly it's not radically improving people's lives to raise their interest rates, right? The whole reason we were doing it was because people were, in fact, not borrowing less at the higher interest rate. So factually, people were staying in a lot of debt and paying more. And to be like, maybe that's helping them, I was like, okay, we've lost the plot here. Like, we're getting to a point where people are just straight up lying to themselves. These are really smart people. These are people with MBAs from Harvard. Y'all should know better.
That's what led Elena to resign from her position. Not long after, she traveled the country to hear the experiences of people living with debt and how people had been impacted by the choices made by companies like Capital One. One thing I was curious about was whether Elena's experience made her reconsider who's responsible for someone having debt. Something I tend to hear around debt, whether it be credit card or student loans, is this idea that people who took out loans made a choice, and as a result, the burden of being in debt falls onto them. But here's what Elena said when I asked her about that.
One of the attitudes about choice that I came to understand here is the two parties are operating with just completely different sets of information. And the bank knows more about what's going to happen to you with the credit card than you do, right? So they have a specific estimate. This person is going to get into $13,000 of debt, and over the next 5 years, they're going to pay $8,000 worth of interest, whatever the case may be. They know that and you don't. And would you make the same decision if they just told you that? One of the most common types of experiences of people I talk to who struggle with debt were people who open up their first credit card somewhere between the ages of 18 and 25. So they open cards because there's this prevailing narrative that, like, having a credit card is a normal part of being an adult. If you don't have a credit card, you are out of the mainstream, right? When you get the credit card, you don't think of yourself as asking for a loan. And so you have a lot of people who open up the credit card because they know it's like the thing to do when you're an adult. And sometimes they kind of know how they're going to use it, and sometimes they don't. And so the nature of the choices is just radically, radically different. And I mean, I do think that the credit card companies are, again, taking an advantage of the fact that other people just don't have a full picture into what's happening.
Thanks for listening to another episode of Lever Time. Lever Time's a production of The Lever. This episode was produced and engineered by me, Arjun Singh, with help from Chris Walker, and editing support from Joel Warner and Lucy Dean Stockton. Our theme music was composed by Nick Campbell. We'll be back next week with more episodes of Lever Time.